Imagine you're on a treasure hunt. You have a map leading to untold riches, but there are traps along the way. That's what investing can feel like. Stick around as we reveal the hidden traps in the investing world that you need to sidestep. Picture this. You're on a road trip, heading to a destination you've never visited. Would you set off without a map or GPS? Unlikely, right? The same principle applies to investing. Jumping into investments without research is like navigating unknown roads without a map. Sounds risky, doesn't it? Avoiding research. Let me tell you about Sarah. She heard about a can't-miss stock from a friend and immediately invested a chunk of her savings. The problem? She didn't do her homework. The company was on shaky ground, with poor financials and no clear future plan. In just a few months, the stock plummeted. Sarah's hard-earned money? Gone. But here's where it gets interesting. With a bit of research, Sarah could have spotted the red flags: declining sales, high debt, and negative reviews from industry experts. Simple tools like reading financial news, checking company reports, and understanding market trends could have saved her from this financial setback. The lesson here is clear. Investing without research is like shooting in the dark. You might hit the target by chance, but more often than not, you'll miss. The good news? You don't have to be a financial wizard to do this research. Start with the basics. Understand what the company does, how it makes money, and its position in the industry. Emotional decisions. Ever made a decision in the heat of the moment and regretted it? The investing world is full of such moments. We'll dive into how to keep a cool head when your money is on the line. Meet Emily. She's been investing for a few years, riding the waves of market highs and lows. One day, the market takes a sharp downturn. Panicked, Emily sells her investments, fearing further loss. But here's the catch. The market rebounds shortly after, and Emily misses out on significant gains. What Emily experienced is what many investors face, the trap of emotional investing. It's natural to feel fear or excitement, but when these emotions drive your investment decisions, that's when you're at risk of making costly mistakes. So, how can you keep your emotions in check? The key is to have a clear investment strategy and stick to it. When the market gets volatile, remind yourself of your long-term goals. Don't let short-term fluctuations derail your plan. Another tip, diversify your portfolio. This way, you're not putting all your emotional eggs in one basket. Diversification can provide a buffer against market swings, helping you stay calm and collected. Falling for fads. Remember the Beanie Baby craze? Fun, but not for your portfolio. The third don't is chasing the latest hot investment without understanding it. I'll show you how this has led many investors astray. Take the story of Mike. He heard about a new cryptocurrency that was the next big thing. Social media was ablaze with success stories. Without a second thought, Mike invested a significant portion of his savings. But here's the twist. The hype was short-lived. The crypto's value tanked as quickly as it soared. Mike was left with a fraction of his investment. What went wrong? Mike fell for the sizzle, not the steak. He was swayed by hype and didn't consider the underlying value or long-term potential. Fads, whether in fashion, tech, or investing, come and go. And when they go, they can leave your finances in disarray. So, how do you avoid this trap? It's all about due diligence. When you hear about an exciting new investment, take a step back. Look beyond the buzz. Is there solid data supporting its success, or is it just speculation and noise? Remember, true investment opportunities have substance, not just sparkle. Overlooking fees. Hidden fees are like termites, slowly eating away at your investments. Our fourth don't is ignoring these fees. I'll break down how to spot them and why they matter more than you think. Consider the case of Lisa, an enthusiastic new investor. She signs up with an investment firm that promises high returns. However, she overlooks one critical detail: the fees. High management fees, transaction costs, and other hidden charges start chipping away at her earnings. It's like going on a road trip, but instead of cruising on the highway, you're constantly stopping to pay tolls. Those tolls add up, and before you know it, they're eating into your travel budget. The same happens with investment fees. So, what's the solution? First, educate yourself about the different types of fees: management fees, transaction fees, and performance fees, to name a few. Understanding these can help you make more informed decisions about where to invest your money. Next, shop around. Compare fee structures of different investment platforms and funds. Sometimes, a lower fee option can offer similar or better returns, especially over the long term. Short-term thinking. Fifth, we're talking about the perils of short-term thinking. Investing is a marathon, not a sprint. I'll share stories of how patience pays off and why the tortoise really does beat the hare in the investing race. Meet Tom, a classic example of short-term thinking in action. Tom is constantly buying and selling stocks, trying to time the market for quick gains. It's exciting, sure, but it's also fraught with risks. The market is unpredictable in the short term, and Tom's strategy is more akin to gambling than investing. In contrast, consider Susan. She chooses a set of diversified investments and holds onto them, focusing on her long-term objectives like retirement, buying a home, or funding her children's education. Even when the market dips, she stays the course, knowing that ups and downs are part of the journey. The difference? While Tom's portfolio swings wildly with the market's whims, Susan sees steady, compounding growth over time. She understands that the real power of investing comes not from chasing immediate profits, but from the magic of compounding over the long term. The key to overcoming this? Knowledge. And where better to gain this knowledge than from the masters themselves? But where can you find those masters? In the books. And to learn about the top 4 must-read investment books, click on the left side of the video. I will meet you there.